Good morning, Scott Nickerson from Crow's.
All right. Good morning, everyone, and welcome to the September 30th, 2020 meeting of the Lextran Board of Directors Finance Committee. Due to the COVID-19 pandemic state of emergency, Chair's executive orders regarding social distancing, this meeting of the Lextran Board of Directors Finance Committee will be held via video teleconference pursuant to Senate 150, signed by the governor on March 30th, and Attorney General Opinion 20-05 in accordance with KRS 61.826, because it was not feasible to offer a primary physical location for today's meeting. I would now like to ask Chairman George Ward to call the Finance Committee meeting to order.
Thank you, Jill. We'll go ahead and call the meeting to order. The first thing I wanted to say was to welcome Jamie to the Finance Committee. We're happy that you've stepped up to be on this committee. It's a very important committee, and Rick and I have been on it. Rick's been on it for a very long time. I've been on it since I've been on the board, and it's good to have fresh eyes and a fresh voice among us. So welcome.
Thank you.
So the first order of business is to approve the minutes of the April 8th, 2020 Finance Committee meeting. It was included in the packet. And Jamie, one thing that you'll learn is there's only two of you, so one needs to make motion, one needs a second.
Yep. So Jamie, a motion to approve. See if Rick is still there.
Rick, you need to unmute to second.
Well, I saw him. Now I see his. Oh, there you are, Rick. I see your computer moving.
Well, to move things along, I'll second. Any discussion? All in favor say aye. Aye.
Aye.
Any opposed? Okay, that carries. So now I'll turn it over to the auditors, and they'll go through our annual audit. So Scott and Shelby, you're on.
Great. Good morning, everyone. This is Scott Nickerson from Crow, and we have Shelby Howell from Crow as well. We are the partner and manager on the Lextran audit, and Lextran's Finance Committee is one of my favorite meetings each year for a couple of reasons. One is that we're able to talk about the audit results, but also talk about your business. And I think that's an important part of associating. Our audit is on the culmination of a period, but at the same time, you have a lot of issues, like many other transit agencies across the country, that it's always good to have dialogue about what other agencies are doing and how they compare and contrast to Lextran. And for the new committee members' benefit, I personally work with about 20 different transit agencies across the country, from very small to LA, Chicago. So I have a good purview of what's happening out there. But the one thing I have learned is, there's so many commonalities, but there's always unique differences. And that really is about how you're serving your community and what's important to your community. So we always try to balance the financial and accounting aspects with the needs of of your constituency. Our goal here today is to give you an overview of the audit for fiscal year June 30, 2020, and to answer any questions you might have about the audit or any the quality of the audit process. So we'll go ahead and walk through. And Nikki, are you controlling the document?
Yes.
Okay,
yes.
If you could go to the audit opinion. So the first thing is, with your approval today, we have planned to issue an unqualified or clean opinion on the financial statements, which cover both Lextran and the fiduciary activities, which is essentially the pension plan for the year ended June 30, 2020. Clean opinion basically means that we believe the financial statements as presented by management are materially correct and that you have met the disclosure requirements set by the standard setters. And so that's an expected conclusion. All right.
Scott, is the terminology now unmodified or unqualified?
Unmodified.
Okay.
Yeah.
I think you said unqualified.
Yeah, you are correct. Unmodified. So basically, there is no exceptions noted in the audit opinion. Related, the next section is management's discussion and analysis, and that is management's opportunity to describe the organization in more detail and provide feedback on the changes year over year. Hopefully, you have a chance to read through that. I think one of the things I wanted to point out is management had put together a brief analysis related to COVID. So, Nikki, if you could maybe move to that, I think it's the last page of the MD&A. The current outlook. Go back one, please. So basically, one of the sections of the MD&A is supposed to provide a current outlook, what's happening today for the organization. So I think Jill and Nikki put together a brief summary of what's happened, primarily related to COVID-19. So that's something that the committee members will want to focus attention on and provide feedback to management. But basically, what it's saying is that since March, you've stopped collecting fares. You've had, like many agencies, have declining passenger traffic. You've made some changes in how you're operating your business and how you're running your routes. But luckily, you also received CARES Act funding that's available of $13.8 million. And Nikki, just to note, I think you should put $1 million after that 13.8. I think I missed that.
Okay.
I had that noted.
Yep, thank you. Was awarded in fiscal year 20, and that shows the availability period from January of 2020 to March of 2025. And so basically, it's just bringing people's attention that your operations have shifted. You do have at least one funding source that's available to provide resources to operate the entity. And all of our clients have similar type disclosures, some more detailed than others, but I think this is a reasonable background as to the types of things you're doing.
Yeah. Let me just interject something here for Jamie's information and orientation. We were sent a 5-year cash flow estimate, and I think you see how that came out. Had we not had this $13.8 million, we'd have been slightly underwater after 5 years. So just be aware that was the reason why Rick and I were concerned about when fare collections were going to start again. And just so the committee knows, I was pretty disappointed with the vote because, the two people that understand the finances the best on the board, put up a motion and were supportive of it. And then people on the board, some of them new, some of them not as new, voted against trying to give Lextran the opportunity to accelerate fare collection to as early as October. And, now it's going to be pushed off probably until at least December before we can, get the board to make comment on it and then give adequate notice to, the users of Lextran that the fares are going to be back in place at some point.
Yeah, I think one thing that we want to consider on this is, you say that Lextran stopped collecting fares in March 2020. Jill or Nikki, you may want to say that continues through September at least, or has continued through the date of release. As far as the George, your comment on the board actions, I don't know if you want to add something here that says that reinstating fares will require a board action or just leave it the way it is.
Well, there's a question about that, and Jill and Nikki, I don't know if you can answer it or not. It came up in a conversation I was having with somebody that I don't think the board took action to stop collecting fares. So does the board have to take action to start collecting fares? I guess maybe if we want to do it before Lextran's ready to do it, maybe we have to. But tell me what you think.
Let us look back, George, and follow up with you on that specific response on whether we need to take official action at a meeting. I also hear you, Scott, and thank you for those comments. I think we can say that differently about how we say we stopped collecting fares. I think we should say temporarily suspended fare collection.
That makes sense.
So and adding the comment that you said, which continues through September at the time of the audit release. So we will add that, and George, Nikki, and I will follow up with you on that specific question if that's okay.
Yeah, that's fine.
All right, thank you.
Jamie, one other thing that you'll see as we go through this is, we take advantage of our time with Scott to bounce questions off him to help us determine, some of the strategy going forward. But also, as he mentioned, because, he's involved with 20 other agencies, to just see what other people are doing. So, Scott, if you could, or if you know what some of the other agencies you're familiar with, what they've done with suspending fares and
Sure.
Reinstating would be helpful.
Sure, and across the board, to give you some variety. For example, LA Metro, they would like to go fare free forever. So they're actually on one extreme end, but they are a totally different, financial entity, and funding is different than Lextran. But they are aiming to go fare free going forward forever. So that's one extreme. The other extreme would be where entities have maintained their full fare structure in place during the pandemic and have used the CARES Act funding or other funding sources or reserves to maintain their fare structure. Another point of view is that people have reduced their routes and so forth to save money, but maintain their fare structure. And then we have entities like Sacramento, where they have done temporary fare stoppage, but they do plan. Most that have done the temporary do plan to go back into motion of collecting fares. So I think the fact that Lextran, temporarily suspended collecting fares is not unusual. I think the way I look at it, and what I told Jill and Nikki, is you have to do a financial calculation of what fare revenues did you possibly forego based on your passenger traffic, and then also look at what costs you may have saved. From not doing the fare collection, because there are expenses that are reduced. From what I found in talking with many agencies, that there's always expenses that are reduced as well as revenues. Mm-hmm. So you have to really look at it on a net basis. And I don't know that, Laura, Nikki, I don't think you guys have been at a point now where you're able to articulate an actual fare loss and an actual expenses that are related to that or reduction related to that. So I think that's really if I'm looking at it from a strict financial sense, you have to kind of look at both factors. We've had comments. So for your benefit, we have a transit roundtable that Nikki involved in, and that's where a lot of our clients and prospects, and they've been stating that fare collection is actually very expensive in the scheme of things, but no one's really measured it. And so a lot of them that are proponing stoppage of fares are saying, look, we have all these people and all these costs that are associated with fare collection that we're not making as much as we thought we might be making. And so they're reevaluating their business to look at that. I think the one thing that for Lextran is your fare revenue, I think it's about 10% of your overall revenues. So you're not highly reliant on fare revenue. The challenge is what's going to happen with property taxes and what's going to happen with your other resources. Mm-hmm. And that's really the unknown right now, whether you're going to see any decreases in any of those other revenue streams. And so I think that entities that typically have a lower reliance on fare revenue oftentimes are saying, can we create other resources to mitigate those losses? Entities like New York, Chicago, Atlanta that are more like 35 or 40% fare revenue reliant, they have a much different issue.
Yeah.
So I don't know that. Hopefully that's just some background. I mean, I think it varies.
Scott, can I ask a couple questions on what you said?
Sure.
Well, and this is one, you said some transit authorities reduced routes to reduce expenses. I believe we reduced some routes.
Right.
Looking at this page, it looked like that only reduced our expenses by 1.2%.
Which page are you looking at?
I'm looking at that page that you're looking at right there, 11. Is that where it would be captured in operating activities? Or how?
Yeah, so I think the challenge here is keep in mind that COVID happened. The real impact probably started hitting in March. So you only have March, April, May, June. So probably 3.5 months, 4 months of impact. So you had 8 months of normal activity. It's hard to do a comparative year over year. So what I think you should probably ask Jill and Nick for is, what did our March through June look like for 19, and what did our March through June look like for 20? And that would give you a better indicator of what impacts are there. And then also you would need the passenger, however you're tracking your passengers, unlinked or linked or whatever, to give an idea of how the passenger traffic has increased or decreased in those time periods. Most entities originally experienced about a 60 to 80% decline in revenue traffic through the end of April, and then they're starting to see it climb back up. But none that I'm aware of climbed up past 80% of where they were before at this time that I'm aware of.
And
thank you. I think they.
Oh, sorry, Jamie. I'll add a little bit to that. Nikki and I certainly can look at that time period for the previous year. I would also add that during that time period, while we did reduce some of our routes on the street, there were no employee layoffs. So based on their bargaining agreement and their guaranteed hours of revenue or guaranteed hours of pay, we still paid those employees. Many of them we utilized in different ways through an agreement with our union. So we kept those people employed, knowing that service would be reinstated at some point in the future. So that is probably why the impact is not as great also.
Yeah, thank you. That was the point I was getting at, is that because he noted that some routes reduced expenses by reducing, some transit authorities reduce routes by reducing routes.
Costs, yeah, sorry.
Costs, yeah. But because we did reduce routes, but we didn't lay off, it was very marginal changes in our operating expenses.
Yes, you say that
we didn't capture August through today. Yeah.
Fuel costs and other costs. Yes, you're right. I mean, the other thing to point out on the revenue side is the University of Kentucky contract, close to half of your revenue, fare revenue. And I know that, Jill, you had commented on that. That's being a significant source, and whether you've made changes to agreement with them is also a key piece to look at as well.
And then another comment, Scott, you made, which I want to add on. So we're very heavily reliant on property tax, which compared to the other tax structures is a much less volatile tax structure compared to income, sales, hotel for some of the other transit authorities that rely on those taxes. I know to speak to that, what you're seeing around the country, since we are so reliant on property, yes, it will be somewhat volatile, but not comparatively volatile.
Yes, you are correct. That is what economists are saying, is that property taxes may not experience the same fluctuations that the other consumer consumption-based taxes may have. Not a lot of entities have property taxes as their revenue source. So I would say most are more the sales tax, income tax, and a lot of the entities have sales tax measures that they implement. So you are unique. I think the only risk that I can point out is no one knows, based on today, I don't believe there's a lag on those taxes, on the property taxes. And so it's really staying in touch with the county to see how revenue are coming in. That's probably the main thing I would be looking at, see have they seen any lag in collections, and also if there's been any delays in collections. And that could just be timing issues as well. So that would be what I would be monitoring going forward. But I do agree with you that economists will say that the property taxes probably are less volatile than other resources.
And then that was my other kind of follow-up. Thanks for property tax. Some of the impacts could be in 2 to 3 years. And I forget in Lexington how much we rely on corporate property tax. It's heavily residential property tax. But that's where the future people are predicting the reduction on corporate property tax as people downsize or change their facility space. So something for us to kind of be thinking about long term on this finance committee.
Right. I think, Jill, I recall being in one of your meetings a year or two ago where you had an economist on taxes. I forget the gentleman's name, or maybe Nikki, you remember, but that's something you could be looking at as well, because I think they were providing some background on tax revenues in your region. Might be
David O'Neill, I think.
Yes, David O'Neill, the property valuer.
That might be something that you could look at to get a context of what they're seeing today and what they foresee for the future after COVID, because I think that discussion was prior to COVID.
It was, and that's good feedback, Scott. And I believe, Nikki, we have asked him the question about the breakdown between commercial and residential.
Yes.
So we have asked that question. I'm not sure that I can give you that specific answer today, but we will continue to follow up on that, especially as they are probably starting to see what those impacts might be.
It would be good, Jill, to talk to him and ask him how many, I think what the right terminology is, how many commercial property owners have come back in to renegotiate their assessment due to loss of business. So,
Okay.
You know, in the hotel industry, which is my background, anytime there was anything like this, that was one of the first places you would go, because the value of your hotel drops significantly as your revenue drops.
All right, that's good. That's good feedback. Thank you.
Well, I'm happy to hear that the management discussion analysis is providing a lot of good conversation. So I'm happy you guys are thinking about these things, and happy to share more information as we gain it from other entities. I think these are all the right questions that you should be looking at as committee members.
Scott, we've given you control of the screen, so you should be able to flip through the pages.
And it is on David's website. It does look like almost 30% of the commercial of our total property assessment totals is commercial. So we're heavily reliant on residential in Lexington, but still that's a significant portion to continue to look at.
Yeah, that makes sense. All right, so go ahead.
I want to go back for a second. I had a question written down, so Nikki, you probably need to answer this, but back on page 4, where you talk about net position, and my question is how much, if any, CARES money was collected in fiscal year 20?
4.4 million.
Okay. Thank you.
Welcome.
All right. Sorry, my mouse is rather quick here. Not letting me go one at a time. Okay, there we go. Yes, you can see, George, the 4.4 million is in that Federal Department of Transportation receivable.
Okay.
That's the majority of that is related to the CARES Act. And that is a significant shift, year over year, as far as the resources that are available to you, using about 4.4 of the 13.8 million. It's my understanding the majority of that money would ultimately be used for some type of operating purposes, and then you have presented a capital project to the FDA as well as a possible project, which is obviously subject to change and approval. To that, I think one of the questions out there, really, every entity, we actually had a poll on our transit roundtable of philosophies on drawing down money, and as you can imagine, it ran the gamut from wait and see. We're not sure what's going to happen. You mentioned what's going to happen 2 or 3 years from now. We don't know what's going to happen 2 or 3 years from now, so let's hold some of it back. Versus, one of my clients, LA Metro, drew 90% of their entire balance on the first day they could. So there is quite a variety. I think in my mind, it's not so much how quickly you draw the money, but what you use it for.
Yep.
And many entities have done a hybrid, where they have a portion operating and a portion capital. Many of the organizations are holding back on their capital just till they get hopefully more or better information of how things are going to play out. That's, I think, the main decision point that most other transit agencies I'm working with are kind of holding back. But the FTA, there's a political aspect to this as well. The FTA is saying, hey, you guys need to spend this money, because how can we say we need more when you're not spending what we have? So there are some political aspects to this. I'm not going to go any further on that, but so I think management made the decision to fund most of his operating wages, I think, for a 3-month period. That's the majority of the funding that was used, and we did audit that activity, that payroll activity. Looking at your balance sheet overall, you can see the majority of your assets are linked to capital assets, which is approximately 34 million of your 72 million in assets. The liability side, you have your notes payable. They're carrying on the balance sheet at about 17.5 million, but ultimately, I think it was about almost 5 million is what you'll physically pay out on your current structure. The remaining, it's my understanding that will reverse itself out in the closure of the new market tax credit program at the end of its term. So when you look at it overall, you did have a positive net position of about $50 million. Slightly less than half of that is net investment in capital assets, which is the capital assets less any related debt. The remainder is unrestricted net position. That unrestricted net position is essentially supported by your cash and receivables, less your non-debt related payables. So that gives you an indicator on how much cash is available. If you think about it from the perspective of how long can our cash last, we can look at the next page. If I can actually get there. If I look at your operating expenses and subtract out depreciation, which is non-cash, you have about 24 million in expenses for the current year. In addition, you have some new market tax. So let's say 25 million, because you got the new market tax fees, et cetera, down there, non-operating. So basically, if you're just looking at it from a liquidity standpoint, you have about 1 year of expenses in your cash and receivables, less your current payables. Question you probably ask, is that good or bad? Depends. I would say that it's more on the good side than the bad side, looking at other transit agencies. But it also has a lot of uncertainty, as we've already talked about, as far as what revenues will be available to you and what property taxes are available. And also the timing of federal assistance. The federal assistance gave you a big boost this year. There's adding 4.4 million, which essentially is most of your change in net position, was the result of that additional funding. You were going to spend that money anyway, with those wages and so forth. So it was an extra resource that was available. But at a high level, you're just around 1 year of expenses. If you recall, George or Rick, that we spent a lot of time operating reserve policy and capital reserve policy. And, I told Jill and Nikki that, you have a lot of decisions to make, whether it's, how we're going to fund the organization, what we want to spend money on, do we want to pay our debt, a lot of different decisions. I still believe that having a reserve policy is probably the first thing that I would do before I make any significant, decisions on how to spend money or how to utilize money that are different than your normal operations. If you recall, an operating reserve policy would just set the standard of how much you would want to have in reserves at any given time, whether it's working capital or just however you want to define it. A capital reserve would be, do we want to build up money beyond what the federal government may be providing? Considering your toll credits have gone away, I believe. So, for capital projects, you may require a matching cash, cash matching. So a capital reserve might tie to your 5 or 10-year capital plan and how much of that would be funded by the federal government, how much you would need to fund. So I think those all link together. The days of liquidity with the reserves would be a key process for me going forward if I was a committee member, just to understand where we are and where we want to be. And I think if you remember from the new market tax credit time period, management did prepare I think it was a 10-year cash flow analysis. I do want to point out that anytime you go beyond like 2 to 3 years, the value diminishes considerably for the cash flow. However, what a lot of my clients have been doing is they've been doing rolling. So they've been doing like a 5-year, and then they do an annual update, to making it more like a rolling 5-year. So that might be something to consider as well. I struggle with even accounting firms typically won't even do a 10-year forecast or provide an opinion on one because there's too much uncertainty. Typically, they won't go beyond 5 years. But I think there are opportunities to look at it on a rolling basis that would make a lot of sense.
Yeah, we do both. And I mean, one of the reasons for 10 was back when we had 10 years left on our note, because I wanted to at least have in my mind what it could look like, even though I know 100 things could change between now and the end of 1 year, let alone 10. But, we needed some assumption to be able to make decisions using. And so I guess typically at these meetings, Scott, there's a couple times a year that we look at it. So, we usually look at it at this meeting, and then, maybe one of the other quarterly meetings that you don't attend, just to, have it in our heads where we think it's going. And obviously the COVID money has changed the dynamic a lot. There's still unknowns because, we don't know when it's going to end. We don't know what the property tax collections are going to be yet, or how quickly the collections are going to happen. And we don't know exactly what UK is going to do from a operating. We keep our fingers crossed. But they've changed their schedule, and so there's going to be a 7-week. I don't know if you know this, Jill, or not, but there's going to be a 7-week intercession period where we'll be closed down from Thanksgiving until the classes don't resume until the 25th of January.
Yes.
So that will change a little bit, although it will go a little longer too. So it goes into
it's 2 extra weeks into May. Is that right?
Yeah, and no spring break. So maybe we come out better. But those are things that we need to have a better idea of where we are so we can make decisions. And the biggest decision, Jamie, that we've been talking about for 5 years is the long-term debt. And what is the prudent thing to do? At this meeting last year, we were several months, maybe many months, into conversations of stretching out our long-term debt to preserve cash. And for whatever reasons, those things kept getting stalled. And, finally an RFP went out, and the results were not good of what we got back recently. So, we've notified respondents that we're closing out that RFP. And now I think we're in a position where, I'd hate to wait longer, but we're really in a position where we could pay it all off if we wanted to. We just need to make sure that the cash flow works. And once we get past some of these unknowns, I would think, this time next year, we'll be past that and we'll have a much better idea. Nikki went through and told me how much interest we would save. Like, if we paid it off by the end of this year, we save like $270-something thousand in interest payments. And if we pay it off in June, we still save almost $250,000. So we probably should still look at that as a way to think of how we're going to handle the long-term debt. And then the other issue that we have is, replacement of the fleet, which is expensive. And one of the flaws, I think, in the financial management in the past is that, we never did put any type of capital reserve into our budget process. And we did this year. Nikki, what did we put in there? 250 or something?
Yeah, I think you're muted.
Sorry, I was on mute.
I could hear you talking through the wall, but I couldn't hear you on the screen.
Yes, that's what we discussed.
So 250,000. So a lot depends on the grants that we get and what match we have to come up with. But one of the big issues we have, and I think you've seen the fleet numbers and how old our fleet is. Yeah. So that's something that we're going to need to address. And so having the CARES money combination of some fleet replacement and some long-term debt elimination it puts us in a much better position than we were in a year ago.
I think one of the things to think about is looking at the assumptions that are building in. I think the challenge with doing a forecast, even 1 year now versus 5 or 10, is all built on assumptions. And so what I had recommended to Jill and Nikki is that they lay out, to the extent that the committee or the board wants to have 1 year, 5 year, 10 year, whatever the case may be, that you really need to have assumptions that everyone understands, and also realize that some of those assumptions are not based on facts. They're based on maybe on historical facts, but not on things that they can control. And so I think detail on the assumptions should be a critical element of putting units. And those assumptions could change year over year. The old way of just doing an inflationary increase every year, 10 years, it's not probably the best way to change things anymore. It might be the only way to do it right now, but things aren't always going to play out that way. So I think the assumptions are critical, and then updating your forecast every year is critical. And I think, George, you had indicated that hopefully within the next year or two that you would have better information as to whether or not paying off the debt or financing your capital projects or whatever makes sense. I would weigh a lot more heavily on the assumptions in that 1 to 2 year period, and spend as much time on the assumptions past that. You could still do it, but it's going to change. So I think those are good points of consideration. I think it also ties into how quickly you draw the funds from the CARES Act. And those are a balancing act because you're incurring the expenses no matter what. Most of the expenses that are eligible under CARES Act, you're spending as part of your operations and maintenance, let's just say.
Yeah.
And so you are going to be expending, as long as you're maintaining your service levels and routes, you're going to spend, $20 million on operations and maintenance in a given year. And so the question is, how do we want to use that CARES Act money? How quickly do we draw it? And then what do we use it for? Because once you draw it, it's cash in the bank, right?
Yeah.
And then you can essentially use that cash as long as you've met your eligible purpose, i.e. incurring those operations or maintenance type expenses. That cash is now yours to deploy how you choose. The question is, should we keep it in our reserves for the uncertainty, or should we use it for, paying off debt or some combination or capital? Those are really, that's what you guys get paid the big bucks for as committee members or board members.
There you go.
Figure that out. And so I'm more than happy to help Jill and Nikki to, I always like to point out what's wrong with assumptions and cash flows. So I'm happy to do that. And as the committee asks management to prepare things. So I'm more than happy to provide my feedback and help them to the extent I can.
Yeah, Scott and I kind of have the same philosophy when it comes to grant funds. Draw them down as soon as you can. So that's what we plan on doing.
Okay. And
thank you for that, Scott, too.
Yeah, just, Scott, just for your knowledge, the sense of urgency on extending the debt now has changed a lot from where we were last year. So, I was thinking maybe we put out another RFP and be more specific in what our request is. But then I got thinking last night, Jill, I haven't even told you this. I don't want to put out an RFP if we don't intend to select somebody and do something. So maybe what we do is, we do our own assumptions and just see what cash flow would be, if we had, for example, 15 years debt at, 4% or whatever number we pick, just so that we have something to compare it to. But
Okay.
I'm happy right now to let things go the way they're going until we have more clarity in the next coming who knows how many months, and then we can make more formal decisions later on.
All right. Thank you, George.
You're welcome.
And that also sparked a couple of questions. So Scott, thank you very much for clarifying that these 1 to 3 year are all based on assumptions. I was telling Jill and Nikki yesterday, so my background's in public finance. It's sometimes like pulling teeth to get public agencies to even be willing to make a 3-year assumption. So I understand 5-year or 10-year assumption are assumptions and I like what George said, use more as a decision point, but not as hard and fast. So thank you for clarifying that. And also, George, made a great point about the aging fleet. And that's something that was in our strategic plan and we've continued to talk about. And I think my recollection is correct. Back in the last recession, we purchased quite a bit of new fleet, 17 new fleet with recovery funding. And now I might be getting the numbers wrong, but now they're aging. So if we do the same thing during this recession and during this funding, I think we just need to be very thoughtful about spacing it out so we don't put ourselves in the same place we are now, 12 years from now, where we have a bunch of fleet aging at one time.
Mm-hmm. That's an astute point, Jamie, and you are correct. We bought a very large chunk of 2007 model vehicles, and as you might expect, they're all coming due, reaching beyond their useful life or coming due for some significant maintenance around the same time. And so it's like you don't just have one problem, you potentially have 15. I wasn't here at that time and obviously can't speak to how that decision was made, but I think Nikki and I have talked, and with our current maintenance team as well, we would like to see a little bit more measured approach, especially if there's something new on the vehicle, which I believe there was in the 2007, something to do with an EPA regulation. It's like buying a car when it's a brand new model of the car. You never want to be the guinea pig. So that I appreciate those comments very much, and hope to be able to take that into consideration.
Yeah. How many, Jill, how many buses do you have in operation?
I'm sorry, say that again.
How many buses do you have in operation?
We have about 66. We do have a few pulled back in our contingency fleet that we could deploy if we had to.
And they're all hitting 12-year. Have they hit 500,000 miles?
Not all 66 of those, no.
Yeah, okay. Many of the cities I work with will do a staggered plan where they putting on technically an equal number of buses, but it's hard to get back on track when you've had such a significant investment in 1 year. So I think that's where that capital plan and reserve would tie in to say, also what kind of buses are you going to buy? Some are more expensive. There's some, you got electric, you got hybrid, you got fossil fuel, hydrogen, you got everything out there. So you have a sustainability question out there as well as to what you're doing in that space, which makes it even more complicated. But the prices of the buses change considerably based on some of those factors. So that's really, I guess, philosophical place to look at as well as what your commitment is to the community from a quality standpoint. But yeah, so building that on staggered, which means to get out of where you are today, you have to build in probably a 5-year, even 10-year plan to get out of it. Mm-hmm. So maybe it's 6 buses a year or 10 buses a year or whatever that equates to. But now you also have the matching piece that you had toll credits providing your match before, which Nikki told me are no longer available. So that typically is a 20% match, right, on the in a normal time period.
Correct.
Okay. All right.
Jill, Alan, Rick's on the phone and he texted me and said that he's not able to speak in. So I don't know if there's a way that you can unmute him from there.
I'm gonna leave that to Alan.
Should be good now.
Rick, are you
Chrisman, can you hear us?
I can hear you, but can you hear me?
Yeah, we can now.
Yes.
Oh, okay. Yeah. Okay. Thank you for unmuting me. Well, I apologize for this, but in our cash projection, are we showing that we're drawing down all that CARES money that's still out there
Yes.
as soon as possible? Okay.
Yes. I show it drawing it down in this fiscal year. It's about 5.9 million.
Okay, good. And that's all of it then? That'll give us the whole thing?
We have 3.5.
I thought it was 13 million.
It is. We have 13. Sorry, we have $3.5 million set back as a capital line to see how things are going, and then we can in the next fiscal year, if we need to, we can change that to operating funds also.
How much did you say, Nikki? 3.1?
Okay.
3.5. Okay. They recommended that you set aside at least one capital item. So we did that with the AVL GPS system that's on the bus that we think will need replacing. So we just set that aside, but if we need to, we can switch that to operating funds.
Okay.
Okay. Have we pulled down $13 million?
No, not yet. We have to incur the expenses first. We've pulled down 4.4 million, and then by the end of December, I should be able to pull down another 5 million. I would say we'll have it all drawn down by at least February.
Okay, all 13 million.
Well, all except 3.5. We're leaving that there for the moment.
Why not just pull it all down?
Well, I can't pull the 3.5 if we leave it in for a capital item.
Okay.
But we can, like I said,
we could put it in the capital later. I mean, I just think you should get it all as soon as you can.
okay.
Yeah. So, Nikki, basically what you're saying is what you presented to FTA included a capital item of about 3.5 million. And in order to release that, you'd have to go back to FTA and say, we'd like to change that.
You would? Okay.
Yes,
okay.
Correct.
Yep. Well, on the bus plan too, I thought we had a bus replacement plan. Do we not?
We do. Uh-huh.
Okay, so it's not like we have to build one from scratch. We already have one.
We have one.
It's already there.
Correct. We have one. It all depends on funding. Some of it we've been able to do through the low or no emissions grants. We've had some with the CMAQ funding, and then we have been able to get at least one bus a year with the formula funding. So we're hoping that the new authorization also continues that.
Okay, but in terms of this big, in the 17 buses that were purchased, I believe that was right after the referendum was passed.
Correct.
A few years,
yeah,
yes.
So it wasn't related to a recession. It was related to the passage of the referendum.
Correct.
I think that was a large influx of money.
The fleet was completely ragged out that time, so we had to buy 17 buses.
Yeah.
And so, but isn't our plan to kind of even out that lump that of the 17 buses? We're going to get to a point where we're only going to bring in like 5 new buses a year or something like that.
Yes, that's correct.
Yeah. Okay. So we have that plan.
Yes, we do. We're not building something from scratch.
Right.
All right. Well, great conversation.
Making progress, Scott. We're at page 14.
I think what I'll do is I'm going to stop here from the cash flow statements on the screen. It is an idea of how cash is being utilized. You had a positive cash flow of $2.8 million. And that's primarily driven by the CARES Act funding. And then, your major disbursements to purchase of capital assets of about 3.7 million during the year. That's offset by federal capital contributions and other federal assistance, which is financing, which is your normal formula operating plus the CARES Act operating. So more on a cash flow basis. So positive cash flow for the year, which is good. The rest of the financial statement disclosures are fairly standard. I did want to point out that we did also perform a single audit on your federal funds. And our conclusion on that was similar to your financial statements, that we're issuing a clean opinion, unmodified opinion on your compliance and internal controls over compliance. The major federal program was the Federal Transit Cluster, which is the majority of your funding, the normal formula funding, and the CARES Act. The CARES Act funding, FTA chose to use the same CFTA number or the same award to do that funding, whereas some other federal agencies issued new CFTAs, so it's a little simpler. Nothing simple, but a little simpler than other entities might have had as far as the funding and the compliance. As I indicated, the CARES Act piece was fairly straightforward because management chose to use operating wages as the primary expense driver. So we were able to look at your payroll records to support those expenditures. And I think you took entire payroll periods. So it was a simple approach. And I think a lot of our clients are choosing that same simple approach to get the big chunk items that are easier to account for and easier to audit. Not that Nikki does anything to make my audit easier, but in her selection, but I do appreciate it.
I was going to say you left no stone unturned.
Right.
On this net operating cash flow, we see net operating cash flow of exactly 0 in 22, 23, 24, and 25. I'm sorry. That looks like we came up with a total and then found numbers to fit it.
Mm.
That's crazy.
When we budget for a balanced budget, and
we're talking about cash. This is not a budget. I mean, the idea that we would completely break even to the penny on cash for 4 consecutive years that's not true. That can't be right.
Hey, Nikki, one thought I had on Rick or Nikki, and I haven't seen your updated, actually Jill sent it the other day, but I have not had a chance to look at it in detail. I think what you need to separate, Nikki, and the team is your balanced budget is looking at a single year and saying, do we have the resources? What resources are available to us, and what expenses do we want to incur? A cash flow statement or cash flow projection may take into account how you're utilizing existing cash. And I think that's the piece that you're not going to see in your budget. So you might want to see how that balanced budget aspect versus a cash flow aspect. And I think it's not so much about cash flow, it's about revenues and expenses that you intend. And then the capital piece, because your income statement or your I haven't looked at your budget closely here today, but the capital outlay is not going to show up on the income statement. It is going to show up on the cash flow. But then it's offset by depreciation, which is a longer term thing. So as I mentioned before, I'll be happy to one of my favorite jobs is to poke holes at cash flow forecasts and budgets. So I'll be happy to look at that and provide feedback to Nikki and Jill. But yeah, it's never going to ever be 0. But I think it's really about how you're going to use the cash, which is the critical decision point that I think George has indicated, and I think Ricky, you're saying is how much cash do we have, and how do we want to deploy that cash? And is any single year of our budget or operations going to deplete our cash? Those are probably the key questions.
And our budget, as far as that goes, is a bit of artifice too, because it all comes out to 0.
Well, the CARES Act does allow you to plug a little bit. So that's one variable, and how you choose.
I'm just saying I'm just saying on a typical budget, we always budget exactly zero, net, which is a bit of artifice, right, to send to the city. But
Yes.
yeah, I mean, I would really like to have an accurate cash flow, and there's going to be some years that are positive and some are negative.
Well, there's so many unknowns. Like we said, it's hard to do those later years. That format was given to us.
But this cannot possibly be right. Okay.
That format was given to us by FTA. We had a visit from FTA after the project was done, and we had to do a cash flow, and that's the format they gave us, and that's what they recommended that we use. And anytime that we have to send cash flow forecast to FTA, that's the format that we have to use. So I just stuck with that format.
Yeah, but this is your board of directors, and I would like to see an accurate one. For internal purposes.
Yeah, I think it's helpful to challenge the cash flows and the decisions, and it gets back to the assumptions, I think. And I think so. In my mind, looking at the assumptions that drove what resources are available and the assumptions that are driving your expenditures, whether they're operating expenditures or capital expenditures, will help tell the story on those cash flows, and it might point out some of the variability that could happen year over year based on how cash is used. And I think ultimately, to me, it's not necessarily the timing of the cash flow, like something going in June versus July, but more of what are the resources that we're putting out the door, to accomplish the things we want to accomplish, and what are the who is going to provide those resources to us. And if there's decisions on to when to recognize those revenues or how to apply to federal funding, or how to decide on any new programming, I think those assumptions should be built in as well. I think most agencies that I work with have continuing operation assumption that they operate the same routes and the same services that they are today for purposes of the cash flows. So I think that's, if you have anything else on the radar as far as changes there, those would have to be assumptions as well.
Yeah, and it's not it's only a guess. It's an estimate. It's what we know, our best guess, right? So no one's holding anybody to, it has to end up that way after 5 years, but I think we just need to do our best to predict it.
Rick, just to clarify, so are you looking at the 5-year flow FY 21 to 25 document? Is that what you're
looking at? I'm looking at the cash flow statement for FY 21-25.
Yes. So not the page in front of us. The.
Oh, okay, you're right. Yeah, I thought we were talking about cash flow.
No.
Okay, I guess I'm ahead of you. I'm sorry.
Yeah, you're probably just ahead. I just wanted to make sure I was looking at the right document, so I see what you're referring to now.
I'm sure the statement of cash flow is not what I'm talking about, and I apologize for that. But yeah, I'm sure the statement of cash flow.
And so you're saying there where it says 0, 0, 0, 0 down at, you would like to see that either a negative or a positive?
I question whether we will have exactly a zero cash, that our operating cash flow will be exactly zero for 4 consecutive years.
I think that gets down to the budgetary basis and differentiating your balanced budget approach when you're going to the local government versus the how you depend.
These are two different things. I think we should have a cash flow for internal purposes, not for sending off to the FTA, city government.
All right. Well, I'm from an audit standpoint, I appreciate everyone's feedback. I think it's a good discussion on the dynamics of your role of supporting the organization and decisions that are made, and then continuous improvement of the information that's made available to you. Just as a wrap up on the audit, we didn't have any, we had 2 minor audit adjustments, which really don't have any bearing on the end results. We had no significant difficulties or no issues that we feel are important to communicate to the committee. I think in the COVID environment, management did well to be able to adapt and provide us with audit information. We were able to do the audit entirely remotely, which takes some effort, but we were able to accomplish our objectives. We did not identify any significant issues in internal controls. The one thing that we did observe is you did have someone out on maternity in the accounting area, and we're just going to recommend that make sure you have backup plans for approving or reallocating duties to keep the segregation of duties. So there was a small window where that was a risk, but with a small accounting group, understanding that that's always going to be a challenge. But we were able to look at journal entries and look at the activities to make sure they met a specific business purpose of the entity. Also, I look forward to working with Carrie at TARC, but also look forward to whoever your next executive director is at Lextran as well. We do have I think a contract extension to do the fiscal year 21 audits. We look forward to working with you on that. And if I can be of any service to any of you throughout the year, I'm more than happy to help. And I'll check in with Jill and Nikki to see how I can help them as they continue to look at the cash flows and providing information the committee needs. Any other questions?
Yeah. What's our liability coverage on the pension?
Okay, so where you stand on the pension? Okay, let me back here. All right. And accountants make this complicated.
Yep.
Sorry. Okay, there are really 3 lines that define your pension. The first one is called net pension asset, which is under the unrestricted non-current assets. So you have a net pension asset of $653,000. Then just below that, you have a deferred outflow, which I'll call similar to an asset. So you have assets related to your pension of about $2.9 million between those 2 numbers. In the liability area, you'll see a deferred inflows of resources pension of 3.2. So basically, if you net those, your exposure right now, as of June 30th, is about $300,000 on your pensions. So I consider that to be well funded.
Yep.
It is probably one of the best, and this is all, based on transit agencies across the country. It is well funded. Most entities are not even close to the funding position you guys are in on your single employer plan. So I think that's a real positive that you've been able to keep up with your commitment to your collective bargaining units and to your employees. So,
yeah, Scott, were there any new accounting standards that you had to put into play this year?
This was a GASB-free year, so the GASBs were deferred to a future year. So that was exciting. Next year,
the GASB said this year, right?
Yeah. Next year, there'll be a couple GASBs, but I don't think any of them are going to have a significant impact on the organization.
Okay.
Yeah, I would say, George, before the stock market went down, we went through a period where we were over 100% funded.
Wow.
So, yeah. So I think when the stock market, this probably doesn't reflect recent gains in the stock market on that analysis, but it's really, really good.
Yeah.
The way I look at it, Rick, it's a good point. From a pure, investment standpoint, that 650 represents your positive aspect of the marketplace. The deferred inflows and outflows represent the future actuarial. It's taking into account more of the actuarial aspects. So it's really the actuarial aspect that is net liability in place. The actual funding of the plan is very high, as you indicated.
Yeah, 100% funding essentially means if we went out of business tomorrow, we would still have enough money to pay off all the pension obligations.
Right. As of June 30th. Yep.
Yeah. That's good.
Yep.
One last question. Is it typical for transit agencies to lease their tires?
Yes.
Okay. And that's just so that I guess the replacements just keep flowing every so many years.
With the caveat that you need enough volume to make it worthwhile. So you'd have to talk with your Goodyears and so forth to see if the volume of tires is enough to get the best deal. So in other words, if you're a larger entity and you're doing thousands of tires a year, you get the more the benefit of it. So I think there's a economic quantity. For the business finance person, or you have that economic order quantity that might impact the value of a leased tire versus purchasing of tires. But I think an analysis can be done.
Okay, I was just making sure. I guess I probably should have known that. I probably did know it at one time, but you know how memories go when you get to be certain ages.
Yeah, it's just like if you're leasing a car, it's the same type of decision.
Yeah.
How are you going to utilize that asset? How long are you going to utilize it? And is there savings from leasing versus buying?
What happens at the end of the lease period to the tires?
So it's a good question. I don't know if Jill or Nikki, you probably have your operations person or maintenance person answer that question, but I think the Goodyear, whoever might be providing the tire lease, they change out the tires periodically based on a maintenance plan. And so I think it's kind of a continuing process where they measure the wear and tear on the tires and they replace them over time to meet whatever quality standard is required.
That's correct. It's they monitor them on a per mile basis, and they do repairs and installations and replacement, things like that.
And typically you would write into the terms of the contract or even the RFP specs,
right?
What happens at the end of the contract. You can, pay out and keep them like a car, or you can turn them back in for possibly a fee, just depending.
Yeah. All right. Well, anybody have any other questions on the audits?
I have a couple questions that we just more for my clarification. On page 4, Scott, there is it says the change in position from 2019 was a 21% increase, which it says later. Yep. Let's see if that's my page 4. Go to the next one.
The operating expenses. Nikki, am I doing this wrong by using my mouse?
I think you're doing it. It starts with transit.
That's correct.
June 30th.
Is it the one that has ridership on it?
Oh, page 9. Let's see if this is the next one. Okay, right here. So that 21% change. That's passenger fares. All right. Mine says page 9, but the bottom says page 4. Well, make everyone scroll. Let's see. If you just scroll up, it looks like it's page 4 of the audit rather than page 4 of the packet.
Yep.
Is it that page?
Yeah.
Well, that's
current assets, 21.8%.
Yep. Change in 21%, which you clarify on the next page, is mostly due to 6 new buses and a timing of a grant, I believe.
That's correct. We didn't buy any buses in 2019 because of the timing of when they arrive. We order them and it may take 18 to 24 months to receive them. So we did pay for 6 new buses in 2020.
So it wasn't that there were no buses in 2019, it was more of a timing.
Correct.
What I'm hearing. And thanks, Rick, for also clarifying on the replacement plan. It seems like there is a replacement plan, although there are quite a few that are getting ready to age out and just kind of smoothing that out long term. So I was just looking there if that was us purchasing a bunch of new buses all at one time, or if it just seems more of a timing that there were some in 2019 and there are some in 2020.
It's a timing thing. We had money left over from the headquarters project, from the loan, so we bought 3 buses with that, and then we also had funds where we sold the old property at 109 Loudon, and we bought 3 buses with that. So that's where the 6 buses came from.
Yeah, I think if you're looking at this, I think the primary driver in this change is really the CARES Act receivable, because your purchases of capital items and your depreciation almost wipe each other out. So the primary driver is really the CARES Act receivable.
Thank you. And then now to page 9 of the audit. Again, there's another 21% decrease there, and this is in passenger fares. And I'm just going to ask Scott if this is consistent with what you're saying. I know you said about, I think you said about 40% of the agencies did not stop collecting fares at all. But for those who did stop collecting fares, is this 21% decrease in passenger fares above average, normal, low average?
The way I look at it is, and Joe and Nikki can jump in, but if you think about it, 3.5 months is about a quarter of the year. And essentially, you didn't collect fares for a quarter of the year. So 21% sounds approximately the right pattern. There may be some, seasonality as to whether bus ridership differs in any different quarter of the year, but that's the way I kind of looked at it at a high level.
Yeah, no, thank you. I'm just looking for large variances here from the previous year and kind of making sure we are on target with those large variances. And then on page 10, it says there was a decrease in maintenance by 13%. Was that due to us being out on the routes less, or was there a lot of maintenance in 2019?
I don't have an answer for that one.
There was. It is based on the contract maintenance we did on repairs of the buses and repairs of the facility, and we did have less of that in 2020.
Yeah. Thank you. I think those are all of the kind of large variances that I saw. And then I think, Scott, you also said something that was really interesting, that we don't have a fund balance policy or a cash reserve policy or an operating reserve policy. And that may be something to start to consider as a finance committee, looking at some other draft policies with some other agencies that you're working with around the country and developing our own reserve policy.
Yeah, Nikki and Jill had asked about that, and it says, I'll see what I can get to help you get a kickstart on that. There isn't a whole lot out there. And I think it's an issue that, in the finance world, you would think people would have that. In the transit space, there hasn't been a lot of forethought on that because they haven't had the disruption that they've had in the last year. Yeah, I can get to what we have on what other agencies are doing, and really they're doing as part of their budgeting process. If you think about it, and I think Rick had a good point of larger transit agencies separate their budget from their finance budget department that does all the grants and the budgeting and forecasting, and then they have an accounting and financial reporting function. So larger entities have the luxury of separating the two and then having a come to Jesus meeting of saying this all makes sense. The challenge you have at Lextran is, you've got, basically one or two people that are trying to make sense of thinking through all the budgeting aspects and the resources, and also thinking about the actual financial reporting. And so I think that's a challenge, but we'll try to find resources that help them to not have to start from scratch and have something that they can build upon.
Yeah, thank you, Scott. I think this also gets to both what George and Rick was saying, looking at that 5-year statement, seeing that reserve go down every year by about $2 million. Is just something to think about at how much do we need? What's a healthy amount? What's too much amount? So we'd love to continue talking about that on the finance committee.
Yeah, agree. All right, so on the audit itself, it's the board that approves it, isn't it, Jill? Nikki?
It's just a report. It doesn't have to be actually approved. It's more of just a review.
It's acknowledged at the board meeting.
And Jamie, just so you know, I usually make a comment that we go through it very thoroughly, which we just have. So I'm glad you're part of that. And so I guess we're done with that part of it. Scott, thank you so much. And Nikki, Jill, and everybody else that's involved with the audit process at Lextran, we appreciate your efforts. I always make the comment that I get involved with a piece of UK's audit every year, and I know the challenges. And we actually, Scott had some FASB issues this year that really delayed ours. So there was a lot of extra work that had to be done, and so I feel your pain, and I appreciate what you do. And Jamie, another thing that I say all the time too is, I've been a finance chair of different organizations, and it is so nice that Nikki knows the answer when you ask her a question.
Thank you.
And a lot of, I can't tell you how many times, in other organizations, well, we'll have to get back to you on that, or we'll have to get back to you on that. And it's just nice that the answers are there. And it's a combination that she knows her job very well, but I think you do probably a pretty good job of anticipating what the questions are going to be as well. So
thank you. Appreciate it.
Yeah.
Just for clarity, we would need this committee's authorization to issue the financial statements. We're ready to issue on our side. There's a couple of tweaks that I think Jill's making on the MD&A that we'll work through today, and we'll just do a final gut check if missing the $1 million thing, and just do a double check. But I think we need the committee's approval for us to release the audit. The audit then gets submitted to the county essentially, because they need it essentially today, I think, right? Nikki?
Yes, correct.
Why this meeting is scheduled today.
Okay. So
we look for an action of the committee to authorize the issuance of the report that I think the board, as Nikki said, acknowledges that the audit has been released.
All right. So there's a couple of minor corrections, plus you're going to fill in that 13.8 million.
Right.
In that one paragraph as well.
That's in the MD&A, adding the $1 million, rewriting the comment about the fare collection, which we discussed at the beginning, to change that to say temporarily suspended, that it continued through the time of the audit, and is being evaluated by the committee and the board.
Okay.
So we'll make those modifications shortly after we get off this call, so that Scott and Shelby can prepare that. But I think barring anything beyond that, Scott, we would be asking for a motion from the Finance Committee to accept this. And then George, I had intended to put a report from the Finance Committee on the board agenda for October.
Yeah. Okay, so we need a motion to authorize the release of the financial statements. Is that correct way to word it, Scott?
Sure.
Or of the audit?
The audited financial statements.
Okay. Jamie or Rick, do you want to make that motion?
Yes, I'll make that motion to accept the audit as presented.
Okay. Is there a second?
Second.
Okay, we have first and second. Is there any further discussion? All in favor, aye. Aye. Any opposed? Okay, that motion carries.
Right. Thank you, Scott
again.
and Shelby. I want to echo those thanks to both of you. I know you worked very hard. I would also like to say thank you to Nikki, and as well as Stephanie Hoke and her department, who did the lion's share of the work for alongside Scott and Shelby with this. So I very much appreciate that, and very similar to you, George, appreciate that when we ask Nikki a question, she knows the answer or can get it to us pretty quickly. She's much very well versed in that, and appreciate that on our team. So
thank you.
I agree as well, and I'm sure Nikki will be very happy when we put this new market tax credit business behind us. Finally.
Yes,
we know you will too, Rick.
I've scheduled a party for March of 2022.
Oh gosh, we have to wait that long.
It's just around the corner, George. Just around the corner.
All right. Well, as we went through the audit, we had discussion on a lot of other things. The next item on the agenda is discussion of the CARES Act funding. And then under proposed agenda items, I just jotted down the capital reserve policy and the cash flow projection. The cash flow projection is going to dictate a lot of the CARES Act funding and uses of that money. But we have talked about the fact that, we want to reevaluate where we stand on paying off the long-term debt. And we also want to look at where we are with capital funds for fleet replacement. And I guess we need a list of other potential needs that are going to come up over the next few years. So we're putting back money for that. I don't know if anybody else wants to comment on CARES Act funding or on proposed agenda items.
I had the same list, George, reserve fund policy, and then your comment on using some of the CARES Act funding to either pay off the building or the fleet replacement. I know you guys are probably well versed in the replacement plan. Either Jill and Nikki could send it to me, or if we could just have a high level at one of the finance committee meetings.
George, I agree with you about this refinancing. Even though I've been a big proponent of that, as you know, I think this CARES Act money has changed everything, and I don't think it's necessary to put it back out for bid after all, in my opinion.
Yeah, I think Jill, you understand that directive now, so we're in good shape with that. We may ask, Nikki maybe to give us an idea of what certain long-term, debt would look like if we feel like we need to do that. But right now, I think that can be put on hold.
Got it.
George, I do think we should have a reserve for building,
Yes.
replacement, like roof and HVAC and things like that.
Yeah. So on the
Thank you all for that. Got it.
Yeah. So when we talk about our capital reserve policy, we do need to include years where we think those major expenses on the building are going to take place as well.
Okay.
And I would like to hear more about the canopy project too.
Rick, did you say canopy?
Yes.
Okay. I'm making some notes.
What is the timing of that canopy project?
This is not as good of an answer as Nikki would give you. That had been stalled a little bit, so let me check where we are right now, and I've been a little bit far away from the canopy project, but obviously we'll need to be getting closer to that. But so I would like to get back to you rather than misspeak, George, if that's okay.
Yeah, that's fine.
Thank you.
And Nikki, as far as financial projections and things, that canopy project is already included in all that, correct?
Yes, we had a lower no emissions grant awarded in 2019 for that. And the good news about that is we did have toll credits. That was our last toll credit match.
Okay.
So it's almost 2.3 million, and we do not have to do the 20%. So
Yeah, no, that's awesome. Okay.
And what's the 30-second version of what's the canopy project?
The canopy with
where we store all the buses out in the yard.
Yeah. It would be especially needed for the electrics. So there was a discussion about do it for the electrics, do it for fleet wide. So that's the quick condensed version.
Yeah. All right. Is there any other business to bring before the Finance Committee? I would entertain a motion.
Oh, sorry, George. The only other thing I had written in my notes was and this is probably a long-term, continue the discussion with PVA on how the commercial property taxes are looking this year, if they have an idea on that.
Yes, and I did take that note earlier.
Maybe David would join the Finance Committee meeting to go over instead of the full board. You think he would?
We can certainly invite him.
Our next meeting scheduled for January 20th.
So he'll have a good idea of who paid on time at least versus what's normal,
Versus
right?
what's normal. Yes. And George, did I get your question correctly? You said to inquire with him about how many commercial properties have asked to renegotiate their valuation as a result of COVID?
Yes.
Okay.
And then he would probably by January also know some of the national trends on not what I'm really hearing is it will impact next fiscal year.
Yeah.
If he can give us some national recommendations for next fiscal year.
Okay. We can certainly invite him.
Yeah, I was thinking because of the way COVID hit, it may have even been past the deadline for people to renegotiate their assessment for the last go round. So he may say that, but I agree with Jamie that tell us what's happened in other places.
That's kind of what we were thinking, that it would not so much affect this year, but it would definitely affect next year.
Although it still doesn't put money in people's pockets to pay it.
Exactly. Right. That's why we think the timing will be off.
I just think, hotels and malls nationally, locally some, but nationally it's going to be a bloodbath.
Oh, yeah.
Even, big office buildings too. Next year for sure. But anyway, okay. If nothing else, entertain a motion to adjourn.
Motion to adjourn.
We'll pretend like Rick seconded it, and I'll say amen. And thanks, everybody.
Thank you all very much.
Thank you.
Goodbye.
Thank you.
Bye-bye.